When it comes to life insurance, we're here to show you the good, the bad, and the ugly. And while I'd love to stand here and tell you that everyone who purchases a policy from McPhee Insurance lives a happily ever after life, that would not be true. I think a lot of our clients would agree that using participating whole life insurance as a financial tool has been a game changer for them. Some of our clients might not feel like they can say that yet because they really haven't had a chance to use their policy to see how much of a game changer it will be, and that's okay. Then there are others who've purchased a policy or policies and have been using them as a place to accumulate wealth, keeping them in the background as part of their financial picture, but not necessarily using them in an active day-to-day way, and that's okay too. When the time comes or the need arises, those policies are going to be there for them. And then there are people like Jeremy, whose name has been changed for privacy. 15 years ago, Jeremy purchased a participating whole life insurance policy through our office. As always, the premium amount was based on Jeremy's specific financial situation, and it was something that was comfortable and affordable for him. Over the years, he has paid a total of $214,779 in premium. Cash value in his policy has grown to $314,135, and it carries a death benefit of $811,000. Before we go on, I want to point out a few things. Jeremy's total premium payments have been $214,779, but his policy's available cash value is $314,135. This means he has access to $99,356 more dollars than what he's paid for this policy. The policy has generated this money because of contractual guarantees and because it's a participating policy with a mutual company. Every year, except for the first year, because insurance companies don't pay dividends in year one, Jeremy's policy has received an annual dividend. Dividends usually start out small, but they can become quite significant over time. Jeremy's policy is no exception, as you will see later on. Policy owners have options for how they receive dividends. We recommend having dividends purchase paid-up insurance because this adds to the death benefit and cash value of the policy, which in turn makes you eligible for an even greater dividend share in future years. Over the years, dividends on Jeremy's policy have been purchasing paid-up insurance as recommended. But here's where this story takes a sad turn. Jeremy has a financial planner who has been talking rates of return. The financial guy has convinced Jeremy that the guaranteed growth of his whole life policy is small and insignificant when compared with the rates of return on various investments. So, he has advised Jeremy to cancel his policy to free up money to invest. Because canceling the policy will also cancel Jeremy's life insurance coverage, the advisor mentioned Jeremy could buy a 10-year term policy. You know, the old buy term, invest the difference strategy. How many times have you wished you could see into the future and know how something will turn out so you can decide which path to take? In a way, that's what financial planning is. Attempting to see far enough ahead so you can prepare accordingly. And when you're in the business of helping others plan for their financial future like we are, you also have to be able to paint a picture of what the future might look like so that an action plan can be mapped clearly. Too often, though, financial planners use unreasonable projections to paint their picture. After talking with Jeremy, it became obvious to us that Jeremy's financial planner has been painting a very unreasonable picture when it comes to rates of return, and sadly, Jeremy is buying it. Completely. For a brief moment, let's take a look at the picture that is so often painted around rates of return to see just how deceptive it can be. Suppose there was an investment that offered a 1.5% average rate of return over a specific amount of years. If we invested money, we would expect to have more than what we originally invested after the investment period was over because of the positive rate of return, right? We certainly wouldn't expect to have less than what we started with at the end of 10 years. And yet, losing money is exactly what could and often does happen. Here's an example. Bob hears of an investment with a 1.5% average rate of return over 10 years, so he invests $10,000. Over the first 5 years, the $10,000 grows to $24,883 as the investment earns a 20% annual return. Then over the next 5 years, there is a negative 17% annual return. Bob's $24,000 turns into $9,802, at which time the investment period is over. Bob is puzzled when he retrieves only $9,802, not even the full $10,000 that he started with. His financial guy congratulates him on earning a positive 1.5% average rate of return. But the financial guy is right. When averaged out, Bob did in fact earn a positive rate of return. He also lost money. And 10 years of time. And that's the part of the picture that gets left out of the painting because it's not pretty. It also doesn't sell investments very well. Now back to Jeremy. His financial planner is telling him he can get a much higher rate of return in investments than what he has received in his policy. To be fair, Life insurance policies don't really have a rate of return, so the financial planner is not exactly wrong, but his comparisons are extremely deceptive. Jeremy has paid $214,000 for his policy over the last 15 years. His total cash value is $314,000. This represents a 46.25% increase on all premiums paid, but this is not a rate of return. The financial planner is discussing investments that have a 20% average rate of return. This is indeed much higher than the guaranteed growth rate of the policy, but then we remember the life insurance policy is not an investment. So although its growth rate might be lower than the rate of return on an investment, it is consistent and it is guaranteed, something an investment by its very definition is not. Next, we can't forget the death benefit on Jeremy's policy. If he died, his family would immediately receive $811,000 of death benefit. To be fair, the financial planner did mention that Jeremy could buy a 10-year term policy. But what will happen after 10 years? With his whole life policy, Jeremy's family would receive this benefit regardless of when he died. With a term policy, his family will only receive the benefit if he dies within the next 10 years, and we certainly hope he does not. I wonder how Jeremy's wife and children would feel about trading lifetime protection for something that only provides coverage for the next 10 years. On to the cost of insurance. Jeremy's financial guy says whole life insurance is expensive and term insurance would be much cheaper. So let's see just how expensive Jeremy's whole life policy is and how much cheaper the term insurance will be for him. Jeremy has paid a total of $214,779 for his policy, but he has $314,135 of cash value. That is $99,356 more than what he's paid, which means Jeremy has not only recovered the entire cost of the policy, he's actually making money because of the guaranteed growth rate by having it. When Jeremy pays his annual premium, his cash value is guaranteed to increase by 20.6% more than his required premium payment. This is not a 20.6% rate of return. This is a contractual guarantee. In addition to the guaranteed cash value increase, the insurance company has declared a dividend for his policy this year that will increase the return on his annual premium from 20.6% to 113.37%. Again, this is not a rate of return. The dividend is set to purchase paid-up insurance, so it becomes part of the policy's guaranteed value. Term insurance does not have the guaranteed growth rate, it cannot build cash value, and it does not earn dividends. So term insurance is definitely not cheaper for Jeremy. Our role at McPhee Insurance is to provide people information they may not have known or help them think about things differently so they can make wise financial decisions. We discussed all of the information I've just shared with you with Jeremy, and we went over a few more things that I'm about to share with you. But at the end of the day, it was Jeremy's decision because it's Jeremy's financial future, not ours. Jeremy chose to follow the advice of the financial planner and surrender his policy. While we think Jeremy might regret this decision in the future, we have no ill feelings and we wish him all the best. And for the sake of his wife and children, we hope those investments turn out even better than the financial planner led him to believe they might. Because at the end of 10 years, his term insurance will expire and he will no longer have any life insurance coverage. At the first of the video, I told you we were here to share the good, the bad, and the ugly when it comes to life insurance. Well, here's some ugly. Upon surrendering his policy, the insurance company sent Jeremy $314,135. That was the cash value of the policy, which in whole life insurance is also the surrender value. Because Jeremy's policy had $99,356 more in cash value than what he had paid in premium, that $99,356 became taxable income to Jeremy when he surrendered his policy. This made his tax bracket jump from 24% to 32%. So not only did he kill the tax-preferred compounding growth of the policy by surrendering it, he also has to pay taxes on it. Next, the term insurance he purchased as part of the new strategy has a higher annual premium than his whole life policy did, and it's actually providing him less coverage. Plus, as we mentioned earlier, after 10 years, the term coverage will expire, so unless he chooses to renew it year by year after that, which would be super expensive, since the premium will jump up by over 1,300% at that time, he'll have no death benefit for his wife or kids. And there's nothing pretty about that. Prior to signing the surrender paperwork, we shared the following information with Jeremy, and we wanted to include it here for you too, not because we're trying to be hard on Jeremy or come back at him with an I told you so moment later, but because we know there are other people out there who are in situations similar to Jeremy's. Maybe they've been told to buy term and invest the difference. Maybe they have bought term and invested the difference and are beginning to question if that really is the best option. Or maybe they have heard whole life insurance is a terrible investment, which is misleading because it's not an investment at all. Regardless of the exact position someone is in, we hope that by sharing the rest of this story, it will help someone somewhere realize that you don't have to choose between one or the other. You can enjoy all the benefits of whole life insurance while also participating in the potential upside of higher returns through the greater risk of investing. In fact, when you think both, the potential gain is even greater than what you could have experienced with either option on its own. Rather than canceling his policy, suppose Jeremy had leveraged it instead. He could have borrowed the $300,000 of cash value he wanted to use for his investment without paying anything in taxes and without losing the guaranteed growth rate of the policy. If he was able to earn the 20% return his financial advisor spoke of, he would have gained $446,496 on that investment. Meanwhile, the policy would have continued growing at its guaranteed growth rate, adding another $90,584 to the cash value over this time period. If we combine the original $300,000 of starting capital, plus the return on the investment, plus the growth of the policy, we get a total of $847,800 in cash, which works out to a 23.07% return instead of just 20%. If, however, the 20% return on the investment never materialized and Jeremy ended up losing 4% instead, he would end up with only $244,612 of his original invested capital. But the policy would still have grown by $90,584 in cash value because of the guaranteed growth rate. And when combined with the $244,000 left over from the investment, the guaranteed growth of his policy would turn a 4% loss into a 2.24% gain. Turning losses like this into gains shows just how valuable participating whole life insurance can be when it comes to creating a buffer against economic volatility and building sustainable wealth. Jeremy's story is sad, but it's one we felt needed to be told in hopes that others in similar situations will be able to consider the facts and make wise financial decisions. Perhaps you are in a position like this right now where you've heard a lot of different information and you're not sure what is accurate, or you know you need to make a decision about some financial things, but you want to make sure you're not throwing out or disregarding something that will be beneficial to you and your family in the future. Whatever your situation may be, we want you to know we are available for you. You can call or email us and schedule a time to discuss your finances and what you'd like to build for the future. We are here to provide information you may not have known or help you think about things differently so you can prepare for your future with confidence. If you've been watching this video thinking, Jeremy had a great policy, I'd kind of like one like that. Or I wonder if the policy I have is as good as Jeremy's was, reach out to us. We designed and sold that policy to Jeremy, and those are the types of policies we design and sell to people in all 50 states. Call us at 702-660-7000 or email us team@mcpheeinsurance.com.